Okay, well, this hasn't been an easy half year. But on the other hand, in the process of building the group, we've done, as you all know, because we were here in April, we've done 3 acquisitions, which is a record for a bit of a half year. So we're happy with that, but trading has been difficult, and so we're going to present the results. So it's you.
Thank you, David. Good evening, everyone. As David just mentioned, I think we've had a fairly challenging year so far. I mean, we started this year with a pretty good order book, and consequently with some optimism. And you know, we've managed to complete 3 acquisitions in the first 4 months of the year, so that was really positive for us. However, for the first 5 months of this year, our order intake was really low, and it just didn't pick up until we got into June, and it did pick up very sharply in June, which I'll talk about a little bit later. But it certainly impacted on our first half revenues. Added to that, we had some production issues in one of our existing vacuum businesses, and our prior year acquisition, Armfield, had a really tough first half in terms of both orders and revenues. So all this together meant that when we looked at revenue as a whole, we're up by close to 2.5 million to 27.3 million, but really it's nowhere near where we expected. And again, that had its knock-on effect on our profits for this period, so they're down by 10%. And EPS affected a little bit further than that because our 2 part-owned businesses also performed pretty well. In terms of the business model, that remains intact. I've mentioned we've done the acquisitions in the first half. Our interim dividend's up 11% to 9 pence. So we're continuing to grow shareholder returns, and we're funding that through the continued robust cash flow from our profitable businesses. In terms of net debt, that has gone up by 6.3 million in the first half, and that's really where we spent 7 million on acquisitions and related acquisition fees. We brought forward the dividend that we normally pay in the second half to the end of March, which was really something to help our private shareholders out. And that was 1 million outflow in the first half, when normally it would be in the second. Those two, that's in excess of 8 million, and then the balancing figure really is the performance of their profitable businesses in generating cash flow. So all in all, that's our kind of a reflection on our highlights for the first period. I just want to draw everyone's attention on the next slide, which is our financial history, to really what we're all about. So we're a long-term play. You know, we've had a tough first half this year and a little bit of a bumpy ride of the last couple of years. But you can see from the beginning, 2005, and where we've grown to, the intention for us to grow revenue, profits, EPS, dividends, increasing returns for our shareholders. And you can see our compound annual growth of close to 10% for the last 8 years has been pretty strong. Additionally, our return on capital, close to 21%, which is up a couple of percent on the comparative period, but it isn't where we want it to be, and we're certainly striving to drive that back up again through the performance of our businesses. And you can see the bottom, the centre of the slide, really what we're all about: growing the dividends, increasing how much acquisition debt we can repay. And as you can see, as we're moving further to the right of that slide and getting closer to today, the growing ability of us to be able to do so. Now, going back to the performance in the first half, we felt it was quite valuable to talk through the order intake for the first half. And for those of you that haven't seen this graph, I mean, we put this on our website, so hopefully anyone that comes to have a look at our corporate presentation is able to see this once every 6 months. But just to walk you through the slide, the red line that you'll see in the graph is our internal sales budget. So as we get into the beginning of 2016, we had an increase for our budget for this year, and then the 2 little steps you'll see are where we made acquisitions during the first half. The black line is our trailing 12 months of orders, and the green line, which is 17 weeks of orders, the last 17 weeks annualised. And so you can see, as we ended last year, and we had a very, very strong Q4 last year. In fact, if you look at the end of 2015, you'll actually see that our green line was ahead of this year's budget as we started the year. So it's a very good and very strong end to the year. And then as we came into January, orders really, really fell off a cliff, and they remained that way for the first 5 months of the period. And as you can see, the big gap between the bottom of that green line and where the red line is, and that's really where we've had big challenge in the period. Despite that, we had a really, really strong return to order intake in June. It's a big short-term recovery in the context of that first half. Because if you think about how sharp that line up is, that's only 4 weeks or so of trade. So it was a very strong recovery in that first half, which meant that by the time we ended the period, we were only 1.6% down in terms of organic order intake. And since the end of the first half, orders have remained in a positive trend, and for the last 11 weeks we've been in reasonable shape, in fairness. But if you
further reasons for the order?
I think we've had a challenging market across the business, and hence otherwise we wouldn't be where we are, which is relatively stable overall. But there have been some pockets where we've had some challenges, and at the same time, as I said about Armfield in its own markets has had a really, really tough time. And when we talked about it briefly in our July trading statement, where we felt that order intake had been suffering due to the fact that Armfield are very successful in selling to developing countries, and a lot of their capital budgets have been cut. So if you're thinking about developing countries as a whole, you've got a lot of them are resource rich. So you either got oil or you've got commodities, and of course the commodity and oil prices have decreased significantly over the last 12 or so months, and that's had an impact on their short-term order performance. There's a feeling within that business in particular where it's they feel it's coming back, but it was quite sharp in the first half, and we certainly recognised a reduction in orders in the rest of the world region where they're very strong. I was probably going to stop at that point and pass you over to David to talk through the acquisitions, unless anyone's got any more questions at this stage. Well, you're on.
Excellent. Well, acquisitions, can I borrow this one?
Sorry, just, if you were to continue that green line, where would it be in relation to the red line for the weeks subsequent?
Just for June's performance, because that's where it goes up to. If you kept getting that performance, we'd be way above. But it's not standard for us to have that every month.
I think we've commented on the 10 weeks which have followed the half year, and of course we said we've managed on an organic fashion, that excludes of course Armfield and the other 3 acquisitions. We've managed to be actually ahead of last year, whilst in June we were 1.6% below last year. So definitely there's progress. We haven't given any comparative with the red line, but I think we've explained that the red line, which is our budget, which was the previous market expectation before July, which was 120 and a bit pence per share, we've said we didn't expect to meet that. So you can suppose that we're well below the red line, but a lot less than we were then. So we still hope to catch up more than we've caught up. We're still ahead in an organic fashion. I think Armfield has greatly reduced its deficit in orders compared to last year, but we have some really challenging comparatives in the run-up to the year end. Because last year, as we said, we had a really good last 3 months, as you can see from the green line there. So, we don't know. Maybe it's going to be as good as that, and that would be good, and then we would still be ahead of last year in terms of orders. But of course, we were assuming that we'd be ahead of last year. So, yeah, you have to assume we're still, the black line will not hit the red one this year, which is, of course, the objective that we have, which is that once a year we have had enough orders in the previous 12 months to cover the sales in the previous 12 months. Otherwise, you're running out. So I don't know whether it answers your question. Okay, an acquisition, we've been here before. This is just an update. We've done 3 deals. One, by the way, is included in the organic because we don't know how to calculate the particular sales and EBIT generated by fire, because it's been completely absorbed with FTT. So we will, from now on, it's become organic. So we're cheating a bit, but it's very small. And the other two deals, you've had some details about it, but for those who were not there, we bought in February a company called Cooled, which makes illumination system for fluorescence microscopies. It's one of the fields of life sciences, and it's basically the replacement for the old-fashioned mercury lamps, which are hot, don't last long, and are difficult to throw away. So we're very pleased with that one. And then at the end of March, we bought Dia-Stron. So Dia-Stron only contributed 3 months. So Dia-Stron makes instruments to test the mechanical properties of fiber. Most of that is hair. 75% of the business is in hair. And this is, very, very overwhelming leader in the market for testing of hair. And of course, who wants to test hair is people who make shampoos, dyes, and conditioners, or curlers, by the way. GHD, is that what it is? So there's a very nice cash cow, that's 75%, because it hasn't got a lot of competition, but the growth is limited by the growth in the need. And the other 25% is very competitive because we're testing other fibers, like carbon fiber and a lot of other new fibers which are developed in industry. There's a lot of people doing that. So there's a lot of growth potential, but it's also a lot of battling to get part of that potential. So it's a completely different business. One thing I should say about the company in general, not only the hair side, is that a lot of their skills is in automation. So they're basically, when you're testing various shampoos on various qualities of hair, you have to do a lot of sampling. And they make these little carousels which you can test 25 strands of hair without any human intervention. It all gets read on the computer screen when you come back. And of course, the nice thing about this is that the hair is put in a cassette, and you put all these cassettes, and the cassettes can only be used once. So you have a very nice consumable business, which goes with this automation of the Dia-Stron equipment. So that's it. We're very pleased. Just to give you an idea of scale, we paid 3.6 million for Cooled, which is 4.5 times the adjusted EBIT that it produced in the year to June. So there was a bit of an earn-out which is included in that. And Dia-Stron, we paid 2.7, and it was 4 times the EBIT that it generated in the previous year. So, like very niche companies, we paid a reasonable price for them. I think they both have quite a lot of growth ahead of them, and we're very pleased with them. So is there any question on
Are you pleased with
this
the
or anything else?
Are you pleased with the Armfield acquisition? Bearing in mind the problems that you've had since.
Yeah, if you're asking me, would I buy it again? I would say yes. Are we pleased? We're not pleased because it didn't perform well, but it performed enormously well last year, more than fulfilled its expectations. And I think it will do well again, but I think there's been a very tough year. We know that Armfield's competitors also had a tough year from talking to them or from seeing what they're offering on their website in terms of promotions. So we think it's been a tough year for that business. We don't buy businesses for a year, but it's nicer if they underperform before we buy them than after. Or just not in the second year. So it's a bit early in the day. We're not pleased with that, but I think it's a very good company. It will do well. So yeah, I would buy it again.
Do you think it'll come good by next year? Is it impossible to say?
Well, we feel it's getting better. As I said, the 10 weeks following the end of June were definitely stronger. And we hope it will carry on. It's a bit early to to give a forecast for that. Yeah, but we definitely hope to have a better year. And the management of the company says, yeah, now we're past the worst. So we'll see. We're always skeptical. We like the people who run our companies to be very good salesmen. And so we have to take always, what a very good salesman, what he says, you have to always discount it a little bit.
What percentage of the slowdown in sales do you think is due to the timing of the public returns?
I think that usually 100% of the shortfall in sales is due to tightening of a public purse, because this is the last thing you need to cross. Your last hurdle when you want to purchase is that. So there's always a lot of desire to buy instruments. Thank goodness there's a lot also of desire to buy our instruments compared to other instruments. We don't feel we have lost market share in any of these companies. But the last hurdle is the most difficult one, is the financing, and often there's not money. But I have to say that we've explained we had production problems in one of our companies. So the shortfall of that company is not due to public funding, it's due to us, and we're not particularly proud of that.
When you spoke last April, May, you mentioned the tough thing where you didn't used to have a first hard 3 months, and then all of a sudden you started to see that becoming a trend. Since we last spoke, have you got any more insight into what's causing that?
No, and we still don't know. What I think I said then is we have for the third time a difficult 3 months. In 2014 it was followed by a bad year, and 2015 it was followed by a good year. So it means that in March, at the end of March, you don't have a clue whether you're going to have a good year or a bad year. We think there's no correlation. What has been different this year is we also had a bad April and May. So, and we don't know why. So the recovery in the year started only in June, and we don't know. And it's possible if next year, I think I said, if next year we have a bad 3 months, we'll know it's like this. It's the new thing now that the first quarter is bad, but it still will not indicate how the balance of the year will behave, and so we don't know.
So when they place an order with you then, how do they do that? And who do they speak to?
Well, on average, who do they speak to?
Yeah.
Well, often, it varies immensely. Sometimes we have agents, sometimes people come to our website and we haven't done much work to get it. And sometimes we have a salesman who's visited them, and sometimes many times, and tries to convince them to do this project and that we're the best. So there's some, and sometimes we have things in the pipeline for years, and sometimes we only hear about a prospect when actually we get the order. It depends very much on the agent. Some agents keep, if an agent is very, very competent and he's been doing that for 20 years and he is able to quote, you can get an order without telling us, and then we get the order, so that's very nice. So an enormous variety, and if you ask us from the order until we deliver it, well, at this point, it's 10.6 weeks. So we know that's the only thing we know exactly, but it varies enormously from company to company.
I'd just like to thank David and Brad for coming along, even when it's not always good news. He still turns out fair weather or shine, or whatever they say. So thank you, David, and thank you, Brad.
Thank you.